Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Bill Laggner and Ira Harris. Bill is principal and co-founder of Bearing Asset Management. He and his managing partner, Kevin Duffy, manage the Bearing Fund using an approach based on identifying boom-bust cycles, value in the marketplace, bubbles, and distortions created by both fiscal and monetary authorities. Ira is an independent trader, a successful hedge fund manager, global macro consultant trading foreign currencies, bonds, commodities, and equities for over 40 years. He was also CME director from 1997 to 2003. Welcome, gentlemen.
Hi, Richard.
Richard, great to be here.
Great. I thought we'd do a focus today on what we see happening for the coming year, 2019, in the economy and the financial markets. What distortions and imbalances can be identified for potential investments and or trading opportunities. So maybe we begin in China with the China slowdown. Do you see a potential unfolding of a severe credit crisis in China? And could this be the catalyst for other effects globally, such as in Europe for the European bond market? Bill, do you want to begin?
Sure. I sound like a broken record on China. I've been talking about it publicly for over 6 years now. The Chinese miracle, the Chinese situation is I think late innings. We're seeing more signs of that now. The Hong Kong property market's falling out of bed. The amount of capital that's fled the country over the last, say 4 to 5 years. I just think that China is trying to deal with a multitude of problems, and a lot of that stems from just central planning. The illusion works great when asset prices are going up and people have this perceived better standard of living, but the reality is it's all built on debt. If it's not built on debt, it's built on a series of other government policies that, let's face it, all of us have seen in history, only buy so much time. There are costs to these interventions, and I think we're in the early stages of seeing what those costs are. I think the economy's slowing down. I think they'll break the peg to the dollar, and I think the global slowdown. It's China. Let's face it, is still a major player in the manufacturing world. So the continued slowdown in Europe, the stagnating economy here in the U.S., I think wreaks havoc on the Chinese. And I can see that there's even more in the last, say, 18 months or so, more disagreement within the Chinese party. And I think that's yet another reflection of an economy going in reverse. They're turning on one another. Very similar to what's happening in the U.S. and even in Europe. The political classes are turning on one another, and those are all indications of late-stage behavior of a cycle.
Just a quick follow-up question on that. For China, you mentioned that you see the potential for the break of the peg. Would that be a devaluation in the currency? And if that were to happen, could that affect the European, especially the European bond market and the euro there?
Yeah, I think they have to break the peg. I think the years ago they did a devaluation in a very short period of time, which was 40, 50%. Will it be as severe this time around? Maybe not, but I do think they need to weaken the currency, and that weakened currency in their mind will try and buy them more time. They can continue to try and export products and keep the illusion going. The problem with China is, and of course they're also trying to attract foreign investment, but what are the rules in China? The rules seem to change weekly. So I don't see real capital making its way, long-term capital making its way into China at this juncture. So, yeah, I think they end up having a devaluation of the currency. They may do it in stages. Most smart macro people I know think they do it in stages. I would probably agree with that. But they've got massive debt issues, and so when countries have massive debt issues, they resort to devaluing the currency, and they do it in ways that we're witnessing today.
And Ira, your thoughts on that?
Well, I'm at this juncture sitting here dazed and confused in some ways, because I go back to the comments that came out of the White House administration from the Chinese, which is, well, if we can work through this trade situation, we could take your trade deficit and basically balance the payments problems. We could take it away because we could buy so much stuff. So when I heard that, it was an interesting comment. Of course, the S&Ps rallied dramatically off of it, but a couple other things didn't happen. At that time, the yuan didn't rally, and when I read people's analysis, they said, well, that's because in order to do that, they have to weaken the currency. And number two, the most ostensible reaction should have been the Mexican peso should have soared. And I'll tell you why. Because if China were to actually embark on a massive consumption program, which that statement to me said, and that's what Michael Pettis, who I have a lot of respect for, has been arguing for 10 years, or as long as I've been reading his work, which is good. And he's a professor who works out of China, so he knows China very well. Because if you embark on a massive consumption program, that yuan has to go higher. Because otherwise, you would just be crushing your middle class who you're trying to aid. Because a weaker currency would mean you're paying more for imports, and that would be exactly what you're trying not to do. So I'm perplexed by wherever we're at here with all the discussion that takes place. And again, because of global supply lines, if China were to massively import mass consumer goods, Mexico would benefit more than any other. And that's because the peso on a relative basis is probably, of the mainstream emerging market currencies, the weakest of anything in the world. We could probably argue the ruble, but Mexico and Russia serve different purposes in the global arena. So I understand people who are talking about depreciating the yuan, but since that announcement came out, the yuan has dropped from actually about 6.87 down to today. We're down about 6.72. So I'm not sure. And then I'm going to add in what happened, what they say Wednesday, Monday. The Chinese actually invited S&P to come in and start rating some of its bonds. Now, when I saw that headline, which didn't get much play in anything else I read, but I thought it was interesting because it tells me the Chinese do have they don't proceed willy-nilly. Now I happen to agree with Mike. I don't trust a thing that comes out of China statistically, and I've blogged about that for 10 years, and I've thought about it for 20 years because my sense of that, and whenever I would speak on panels or anything, it's really a simple rule. If you don't allow Google to operate freely, I can't trust any information that you're willing to either put out because you don't let a free flow of information in. So if you're controlling what comes in, by definition, you've already controlled what comes out. So I don't give China much credence for that. But that doesn't mean that China does not have a concept here about where they want to go. They always have a concept. How they get there is what we'll discuss and we'll argue about. But I think one of the main thrusts of China is, because they know how important this is, that they'd like to establish a true competitor to the U.S. dollar as a reserve currency. I believe that because they don't trust the U.S. And there's a lot not to trust about the U.S. And one of the themes we'll get into, I'm sure, and going forward this year, and what staggers me and makes me less bullish on the United States in any regard is that we are operating at full employment and yet have $1 trillion a year deficit. That is a problem to me, because the last time we were at a full employment economy, which is 97, 98, 99, we were running budget surpluses. So we're in a whole different atmosphere here. And then you follow the arguments that are actually building. I love that they're actually making it out to the mainstream thought on the MMT, the modern monetary theorists, and how you don't have to worry about deficits, just print more money. So in that regard, I think the Chinese are, they hold a lot of dollar assets, as do others. Any type of reaction from a monetary authority to just print more money should make everybody nervous about holding that asset. And because the dollar is a reserve currency of the world, we're all forced to hold that asset. So, I'm not sure about, this is the long answer to it. I'm not sure about the depreciating of the yuan. So I'm going to hold my powder on that. And I need to see other things here. And I'm more concerned right now. Yes, the Chinese have massive amounts of debt, but relative to other things, their debt's not as great as the U.S. And the U.S. is hemorrhaging debt at a time when they ought not to be. And if you're really a Keynesian, you should accept that premise, because Richard, we have a lot of Austrian discussion on these podcasts, and I've been very proud to do many of them. And the Keynesian view is, hey, economic times are good. You're supposed to be running surpluses, or at least not massive deficits. The deficits come from demand stimulus, and we certainly don't need that. So I'll stop there.
Can I just add one more thing to what you said, Ira?
Yep.
I read Michael Pettis's work too, and I like a lot of his work. I think that the most difficult thing, you hit on it, Ira, we really don't know the extent of the debt situation in China, and because Google and other groups are not really allowed to get data, whether it's on Chinese banks, et cetera, I just think there's such a black hole that it's very difficult to analyze this properly. We realize it's a lot of debt. We realize that the global economy is slowing. Yes, they want to go to a consumption-based economy, but what are they trying to build their quote-unquote economy on? If it's layers and layers of different agency debt or debt in various industries, et cetera. The banking system, many people think they need to recapitalize the banking system. I'm in agreement there. It's the world is in debt, and they're all playing the same game. So it's going to be fascinating to watch it all unfold.
And on Europe specifically, Bill, what are your thoughts in terms of the evolving central bank policy trends there, and the potential for the financial crisis phase 2, if you will, to start out of Europe?
Yeah, so I remember going back to the Greek situation, and which was 2011. I was convinced that Greece would leave, and you would start to see the breakup of the European Union. And of course, the decisions that they made to essentially keep Greece within the EU and start this process of bailouts and more taxes and more liens on the future livelihood there. Deutsche Bank, a company that we've been short for quite a while. I mean, Deutsche Bank is telling you there are problems. I think 2 years ago there was a French junk bond issuer that was refinancing debt for 3 years at a negative interest rate, all thanks to the ECB. I think they're at 50% of GDP now, the size of their balance sheet. So, Draghi was listening to himself speak the other day. I just think that they're going to continue to intervene. I don't see them, tightening policy there. And it'll just be, whatever the interventions look like in the future, they're going to all equate to the same thing, which is loose monetary policy and trying to keep nominal asset prices from declining too much.
And Ira, your thoughts on Europe and the potential for a financial crisis to begin from there?
Well, Bill, we find great commonality in Europe because the most nefarious man in the world is Mario Draghi. People really don't understand what he's done here, but building that massive balance sheet has trapped everybody in Europe. So I'm going to 100% agree with you. Europe is a mess, and they are walking down this road of perfidy, and it is perfidy. Because Mario really has no plan. His plan was to, the most honest thing he ever said was to do whatever it takes, no taboos, to preserve the euro. And in that regard, he has really saddled them in a terrible, terrible situation. Of course, Merkel was his guardian angel and paved the way for him. So I'm agreeing. There's nowhere for them to go. Nowhere. What was last week's blog, Richard, about Mario Draghi's circus, which the circus was in town. Nothing he said had a bit of honesty to it. He tries to control the narrative, and of course now the narrative is what his two words: persistence of conditions that they can't control, and makes the assessment difficult. Of course, it's difficult. They've destroyed the German savers because I'm on the Financial Repression Authority. So if you want to see the master of financial repression, take a look at Europe and what they've done to German savers. Because if you're running inflation in a country of 1.6, 1.7, you have a GDP of over 2%, and you have negative interest rates on a 2-year note of 60 basis points, you got a serious problem. And while they're sweeping it all under the rug, the problem is just building and building and building. So I think that's the real stumbling block to where we're going to go here. Europe, China is interesting, and Trump really, his disdain for Merkel and Macron for the way that he was, and here's a man who doesn't take those slights lightly. So I would watch his response to Europe, and Europe is definitely, the German auto sector is definitely afraid of a 25% tariff. And while we're concentrating on China, we don't hear much about Europe. But I'm very cautious there. And the European Central Bank, again, has really put the world into a very difficult situation. And it's all based on debt. And as somebody aptly called it, the doom loop, because you have the European commercial banks buying the sovereign debt. Why? Because it's a zero risk weighting. So I can buy all the Italian bonds I want, no matter what you think about them, and I get to carry them on my books with no reserves. That's a pretty good game.
Yeah. Yeah. It's, can I add one more thing to Europe? And great points on Germany, by the way. I look at what happened in Greece, and people forget about Greece, but you look at what's happened in that country since, look, there was a lot of corruption in the country, and of course we know how, when the euro was created, what they did to the Greek economy. Thank you, Goldman Sachs. The fact that these new taxes and other regulations were then brought into the Greek economy, it just, it's throwing yet another wet blanket on the fire. And I see the same things happening. Look what's happening in France, for example, right? Look at all the different taxes and so on. They've got people now protesting, and essentially it's just these systems that they've created are unwinding in slow motion. It just doesn't work anymore.
Bill, what do you? Yeah, go ahead, Ira.
I think that's absolutely right. You know what? And Alexis Tsipras, they slapped him pretty good. But you give me Varoufakis any day, because I'd rather listen to him. And I think he talks more of the truth. Again, it's not their narrative, but it's the narrative of really what's going on. And they applaud. Spain is still at 14.5% unemployment. So they've got massive problems. And a lot of them start with the monetary policy, because Mario Draghi did follow Ben Bernanke down the rabbit hole. And not only one pill makes you small or one pill makes you tall. He took the one that made him tall, and he just can't get out from that rabbit hole. He will not fit back through it.
Mm-hmm.
Bill, for 2019, what do you see as the biggest risk factors? Market risk, credit risk, geopolitical risk. Where do you see those?
Boy, that's a great question. Well, I think it's pretty clear that the economy is slowing globally. Many of the macro figures show that. I think the Fed is done raising interest rates. I don't think the Fed can continue to tighten interest rates. I do agree with Ira that the U.S. will continue to run significant, and the rest of the world will run these deficits. We'll have more intervention, fiscal and monetary interventions, probably later this year. And of course, credit spreads will widen. We're already seeing the beginning of credit spreads widening. The leveraged loan market pretty much shut down at the end of last year. So, and commodity prices look actually rather weak. So, you could see a pretty interesting contractionary wave unfold this year. They're not going to sit idle. They're going to try and fight it, is my guess. And so I could see where stock prices could go down at least, 20% from here, maybe 30% from here. I think earnings are going to be a major disappointment, and credit spreads will continue to widen. So again, they're not going to sit idle. They will immediately intervene. They will basically threaten to go to negative interest rates. I've been saying this for several years. The central banks want to tighten interest rates, but they can't. The economy is too weak. The economy is weak for all the reasons we were discussing earlier: intervention, debt, the size of government vis-a-vis the real economy, regulation. So I think they're going to intervene. I think they will threaten to go to negative interest rates. And I wouldn't be surprised if the deficits go north of, $1 trillion a year here in the U.S. I could see where the deficits could go to $1.5 trillion very easily.
And Ira, your thoughts on the biggest risk factors?
To me, there's so many of them. Europe is the one that we discussed, the Chinese, and and again, I'll come back to it. And Bill was nice enough to really give it a push off the edge, which is the debt levels. You just cannot get away. And I agree with him. I think that there's no way that earnings can sustain themselves here with higher interest rate costs. And coupled with that, if you get higher wages, it has to eat into profitability. So these people who put forth these growth and profit numbers, which you're not coming off of low profits historically. You're at basically historically all-time high, a sustained level of profitability, which can't sustain itself if labor is to get a bigger piece of the pie and interest rates take a bigger hit. I just don't see. Now, does that result in geopolitical problems? Not sure. We're seeing some of it. But on a global basis, where I see the greatest threat is, of course, from the Prime Minister of Turkey, Erdogan, who continues to get favorable play. And I certainly don't understand how, because he always takes the other side of the United States. But down in Venezuela, Putin, Erdogan, the Chinese, line up. It almost looks like the scene from Blazing Saddles, where all the bad guys are lined up waiting to get signed up. They can't get out from themselves, So, but I think I make the Mideast with Erdogan and whatever he is really trying to do there, potentially a major global risk. There's so many. I can't even enumerate which one would be the most, but because I've been to the economics, this debt issue is really bothersome to me. So I'm in Bill's camp with that.
Given all this backdrop, Bill, where do you see trading opportunities, investment opportunities? In particular, what are your thoughts on the gold euro and gold yen cross rates, as well as the yield curve steepening or flattening?
Yeah, I don't see, again, because I believe we don't have bond markets anymore. I think the central banks have distorted the, Jim Grant likes to say there are no more traffic signals, right? They're all flashing the same color. So, central banks intervene, they distort the prices. You create these false signals that enter the marketplace. I'm very I've been bullish on gold since 2002. It's very clear to me that they were going to print a lot of money, and they have, and they'll continue to print money. So gold looks like it's finally breaking out of I'm not a hardcore technical analyst, but it looks like it's breaking out of a falling wedge since 2011, when we were up around 1750. So I'm bullish on gold, and I'm bullish on gold not just against dollars, but against yen and euro. Whether or not the yield curve stays inverted, it's hard to say. I think what we're really betting on is, how quickly will the central bank here in the U.S. cut interest rates? And, Ira brings up a good point. You've got wages rising, so maybe they don't have the room that they had at this juncture, right, that they had back in 08, 09, 2010. So that's, bullish on gold. I think the other thing that's interesting is watching the Fang stocks decline, right? So a lot of the movement coming out of 2015, the NASDAQ was just a handful of companies. And that it looks like that the Fang bubble has burst. And so, I think that, that's going to be a real problem for the broad market as well.
And you see interest rates falling, as you mentioned earlier.
No, I think that the central bank, they talk a great game, but Powell's already flip-flopped, 3 or 4 times since Christmas Eve, when things were melting down. My guess is that they will try to lower interest rates, and/or the government will run a greater deficit if the economy slows drastically, in the second half of the year. I'll add the following. I do, without getting too much off topic, I do think that the technology wave of decentralization is something that is a very positive catalyst for the global economy, but it's a tiny piece of the economy today. But I do see how that could be a very positive outcome for the global economy. That doesn't mean we're going to dodge the debt bubble or we're going to dodge the recession. I just think that longer term, that's something to keep an eye on.
But by that, do you mean like blockchain and robotics, process automation?
Yeah, Internet of Things, the blockchain. I've spent a lot of time in the space the last 5 years. When I look at all of the inefficiencies in just supply chain, for example, you're talking about a couple $1 trillion a year just in inefficiencies. And so the movement of money, why is the foreign exchange market 25 times the size of the global economy? The disintermediation of finance is something that I think will change the world, but that's a intermediate, longer term phenomenon.
And Ira, your thoughts on trading opportunities, investments in particular for the gold euro, gold yen cross rates and the yield curve?
Well, Bill and I've never talked, but those have been my favorite trades. And in fact, my biggest trade, I took it off this morning, was long gold and short the Swiss, which has been good because the Swiss was a little unnerving. But if you want to, Richard, I always give the alchemist of the. It used to be the year, but now it's a decade, and now it's probably the millennium. And I'm not talking about. I'm going back to zero. The Swiss Central Bank, the Swiss National Bank gets, of course, the alchemy of the year because they get to print Swiss francs that don't seem to go down in value anyway and buy equities, global equities. What better is that? That's the dream of the MMT crowd.
Yeah.
What better is it? Let me go print let me go print 1 billion Swiss francs and go buy $1 billion worth of Apple stock. Wow, that's a great, thank you very much. And that's what they do. And then they're trying to figure out how they can get out of this hole. But the rest of the world is starting to mimic them. But so I believe in all the gold currencies. The gold dollar has not been that great, but U.S. rates have been going up, and you actually get, two things. Everybody, and I have this discussion constantly because my phone rings off the hook all the time talking about gold. Don't buy into the inflation nonsense. By that time, gold is too late. Gold is a protection against central banks absolutely realizing that they've gone down a path that they have no way out of, and that the effects of what they've done, that's what you want to go for. The inflation will be the ultimate ugly effect. But and people say, well, it's been a bad investment. Oh, really? How's the dollar done? Would you rather own gold for the last 50 years or to be in dollars if you were a foreigner? I would say you've been much better off being in gold. So the gold has done what it's supposed to, be a store of value. But okay, let's get beyond that. So then let's go. I happen to be, now, my attitude is that, and I've done it, and Richard, I've done a lot of work on yield curves for 35 years, 40 years already. This is going to get interesting this year, and I'm looking for steepeners because my attitude is with this debt overhang, and yes, debt does matter regardless of what Larry Summers and Jason Furman's Monday recent article in Foreign Affairs on Monday. It does matter, and it's going to have a cost. And I say that any money manager who would put their clients in anything longer than a 5-year duration of U.S. debt ought to have to take have to be re-examined because they're evidently not operating as a fiduciary, because there's just too much uncertainty with the U.S. debt situation. I'm not even getting into the entitlement argument. I'm just talking again. We're running $1 trillion deficit at full employment. That's heresy if you're a Keynesian. Heresy. So I see those as worthwhile investments. I'm looking at Germany, though, as we come back to Germany, because my question to any German is, where do you go to invest? What are you doing with your money? Are you buying 2-year? Are we buying 2-year German debt? Is that doing it for you? I don't think so. The shots yielding a negative 60 basis points. You're better off putting it into your mattresses, of course, because it'll do you better. So, the real estate in Germany has already reached almost a bubble proportion, which is highly unusual for Germans because they don't leverage themselves. So I'm going to watch the DAX closely. I know, to me, the German assets, the fear to them, of course, is that Trump gets aggressive and really starts pushing for tariffs on the German auto sector. That'll keep me. So I'm not invested there yet, but I'm watching because my attitude is, where do I go if I'm a German? I also like Mexico because, as I say, if the Chinese are serious in what they presented on the issue of, we can, they're going to really ramp up their imports. Mexico has to be a beneficiary of that. So I'm going to watch closely, and again, on a relative basis, the peso is cheap, and it also pays you 8.25% on overnight interest rates. I'm not involved there yet. I'm waiting for the 200-week moving average, and I, like Mike, like Bill, I'm not that good of a technician. I use it to establish my losses and potential, if I see momentum building, but it's not the first place I go to do my work. And that covers me in the short term here. But again, I look at it with a trader's eye more than I do necessarily with a long-term investor's eye. So I always caution that.
Well, great insight as always, gentlemen.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.